Tesla. The name alone sparks 1,000 debates. Is it the future of transportation, energy, and AI, all rolled into one visionary company? Or is it the most overhyped stock in history, a house of cards waiting for a gust of wind? Today, we were diving deep into one of the most polarizing questions on Wall Street. Is Tesla wildly overvalued? Or is it a hidden gem still waiting to be fully appreciated? Let's start with the bull case. The argument for why Tesla is not just a car company, but a tech titan in the making. First, you have the electric vehicle market. Tesla isn't just a player, it's the trendsetter. They didn't just build an electric car, they made electric cars cool. They created a brand that people aspire to own, much like Apple did with smartphones. Their production numbers are staggering. From a few thousand cars a decade ago to millions, the growth has been exponential. And they're not slowing down. With gigafactories sprouting up around the globe, they're scaling production at a pace legacy automakers are struggling to match. The bulls will point to Tesla's vertical integration. They don't just assemble cars. They control the entire ecosystem. They design their own chips, write their own software, build their own charging network, the superchargers, and are even getting into raw material processing. This gives them immense control over their supply chain and innovation cycle. SPA. While other car companies were outsourcing their tech, Tesla was building it in-house, creating a powerful moat around its business. Then there's the software and data. Every Tesla is a computer on wheels, constantly collecting real-world driving data. This data is the lifeblood for their full self-driving, or FSD, ambitions. The bulls see FSD not as a feature, but as a revolutionary technology that could transform transportation as we know it. Martin. A future of robotaxis, where your Tesla earns money for you while you sleep. If they crack this, the valuation of the car itself becomes secondary to the software as service revenue it can generate. The potential market for autonomous mobility is measured in trillions, not billions. And let's not forget the other parts of the Tesla empire. Tesla Energy is quietly becoming a massive business, deploying solar panels and megapack battery storage solutions globally. These are crucial for stabilizing power grids as the world transitions to renewable energy. Some analysts believe the energy division alone could one day rival the automotive business. And then there's Optimus, the humanoid robot. While still in early development, Elon Musk envisions a future where these robots handle dangerous, repetitive, or boring tasks, potentially solving labor shortages and revolutionizing manufacturing and daily life. Even a fraction of this vision becomes reality. Today's stock price might look like a bargain in hindsight. The bull argument is a bet on optionality and innovation. You're not just buying a car company. You're investing in a portfolio of world-changing ventures led by a visionary CEO. Now, let's flip the coin and hear from the bears. The argument against Tesla is just as compelling, and it starts with one word: valuation. For years, Tesla has been valued at more than the next 10 largest automakers combined. Divers look at this and see a classic bubble. They argue that Tesla's stock price isn't based on current fundamentals like profits or sales, but on pure speculation and hype. They'll point to the competition. When Tesla started, the EV landscape was a barren desert. Now, it's a crowded jungle. Every major legacy automaker, from Ford and GM to Volkswagen and Hyundai, is pouring billions into electrification. Plus, you have a flood of new agile EV startups from China, like BYD, NIO, and XPeng, which are not only competing on price, but also on technology and design. BYD has already surpassed Tesla in total EV sales in certain quarters. The bears argue that Tesla's first-mover advantage is eroding fast, and as competition intensifies, profit margins will inevitably come under pressure. Next, the bears scrutinize those futuristic promises, especially full self-driving. They'll tell you that FSD has been just around the corner for years. The promises have been bold, but the reality is still a Level 2 drive assist system that requires constant human supervision. Achieving true hands-off, eyes-off Level 5 autonomy is an incredibly complex challenge, and there's no guarantee Tesla will be the first to solve it, if it can be solved at all. The bears see the massive valuation placed on FSD as a bet on a technology that may never fully materialize in the way it's been promised. Then there's the execution risk. and what's often called keyman risk. Company's fate is intrinsically linked to Elon Musk. His attention is divided between Tesla, SpaceX, The Boring Company, and Neuralink. His unpredictable behavior and controversial public statements can create volatility and distract from the company's core mission. While his vision is a driver for the bulls, for the bears, his unpredictability is a significant liability. What happens to Tesla if he steps back or gets pulled into another major project? Bears also look at the core business selling cars and see challenges. The market for high-end EVs is becoming saturated. To keep growing, Tesla has to move down market, which they've done with models like the Model 3 and Y, but this means lower prices and thinner margins. We've seen Tesla implement several price cuts globally to spur demand, which is a sign of increasing competition and a potential red flag for profitability. Can they maintain their premium valuation while competing in the mass market against established giants? So, where does that leave us? Overvalued, hype machine, or a misunderstood gem? The truth is, it depends entirely on your perspective and your investment timeline. If you are a fundamental, value-oriented investor who looks at price-to-earnings ratios and current cash flow, you'll likely see Tesla as wildly overvalued. You're comparing it to other car companies, and on that basis, the numbers just don't add up. The risks, competition, execution, valuation are too high for the current price. You see a car company with a tech company's stock multiple, and that's a red flag. However, if you are a growth-oriented venture capital-style investor, you might see a completely different picture. You're not buying Tesla for what it is today. You're buying it for what it could become in 10 or 20 years. You see the potential of FSD, the energy business, and robotics. You believe in the vision and the company's ability to innovate and disrupt multiple industries at once. For you, comparing Tesla to Ford is like comparing Amazon in 1999 to a traditional bookstore. The comparison misses the point entirely. You see the current volatility as the price of admission for potentially world-changing returns. Ultimately, Tesla forces us to ask what we're really investing in. Are we investing in the proven reality of today or the unproven potential of tomorrow? Are we paying for car production numbers or for data, software, and artificial intelligence? There's no easy answer, and anyone who tells you they know for certain what Tesla's stock will do is probably trying to sell you something. The bull case requires a leap of faith in technological disruption and long-term vision. The bear case is grounded in financial fundamentals and competitive reality. What do you think? Are you on Team Bull, betting on a future powered by Tesla, or are you on Team Bear, convinced the hype has gone too far? Let me know your thoughts in the comments below. It's one of the most fascinating stories in modern business, and it's far from over. Thanks for watching. And don't forget to like and subscribe for more deep dives into the companies shaping our world. See you next time.